One of our colleagues on Bloomberg early this morning on radio said this is a rare Fed meeting where it's going to matter both what they say and what they do. So start with what they're likely to do on the balance sheet.
Well, MetLife Investment Management, we are expecting that they are going to begin to reduce the size of the balance sheet. They'll announce the program today, and it will begin October 1. And that means that they will reach their maximum amount of drawdowns at the end of next year. So because it's a step process. And I think that's good for everyone. I think we need to see the balance sheet begin to come down. I think we need to see that normalization. We think it'll be a positive, but it's not without risk.
Well, exactly, not without risk. We've never really seen this happen before because we haven't seen this level of balance sheet before. So what are the risks potentially?
Well, I think we can look to the taper tantrum to see what the risks are, which is people forget that when the taper tantrum occurred and Bernanke announced that they were going to eventually have to taper asset purchases, it was pretty much, it should have been a non-event. I mean, at some point, the Fed was going to have to stop buying treasuries or they'd own them all. So for the Fed chair to say that wasn't really kind of a giant surprise. And he wasn't announcing that it was beginning that day. But what we saw was a 150 basis point move in yields on that. We're not expecting that, but I do think the markets are a bit too sanguine in terms of expecting really no move in yields or no abrupt change.
But Drew, there was a major difference. In 2013, there was an open-ended commitment to QE that we didn't really know when it would end, where the taper would happen. Say with the ECB, there's actually a time limit on, say, look, at the end of the year, we're going to finish at 60, then we'll talk about where we go next. For the Fed, we were in QE forever mode in 2013. Isn't that the big difference here?
That is a good difference. It's an important difference. But I think what people are missing in this part is that when the Fed doesn't roll over these securities, the Treasury still has to fund those securities. So they're going to have to issuance to the market, to the public market, is going to have to increase. And so market participants are going to be faced with an increase in supply from this. So it's effectively like the Fed selling it, although they're not coming out and selling it. It's the Treasury is going to have to sell it, and the Treasury is going to get to decide what area of the yield curve they sell it in, which is another factor that I think is being generally overlooked, with the idea being that the Treasury is not going to do anything disruptive to the Fed. I think that's a big assumption.